In today's class, I promised you what I call the money net. It's one of our it's number 5 of one of our 12 techniques. Okay, it's number 5. I told you in Tuesday's email that it was a combination of a bull call spread and another secret ingredient that lets you get paid to put it on. Okay, and so we'll be sharing that here in just a moment. You actually get paid to put on a bull call spread. That's the truth. Okay, but I need to set the stage a little bit. I need to kind of take you a little bit through this process. It's going to be a very abbreviated process. Okay, a very abbreviated explanation of how we got here. But first of all, I wonder how many of you got your start. Okay, are you still trading covered calls as your primary way of taking income from the market? So what I'm going to do real quick is open up a poll here and just have the folks that are on the line today. I'm going to ask you, what are you doing? What kinds of techniques are you using? And I think you can actually answer in more than one category, but in case we've been having some difficulty with the polls. In case you can't vote in more than one category, please put the primary method first, okay? Primary method first, and then if it lets you choose more, then go ahead and send those up too, okay? Okay, it looks like you can vote in more than one category. I've got totals that make more than 100%, so obviously you're able to vote in more than one category. Okay. All right, so that's filling in. Nobody has said I'm not trading options at all, and nobody has said that they're doing the dangerous stuff, okay? I'm going to actually show you a way today to do the dangerous stuff without doing the dangerous stuff, do the dangerous stuff without risk. Okay, so this is good. We've got most folks have had an opportunity to vote. I'm going to leave it up for about another 5 seconds. That'll take us to a full minute here. And the reason for these polls is so that we can make this really interactive, okay? And I'm going to be answering questions as we go also. Okay, let me, pardon me, got hiccups. Let me close that, and I'm going to share it with everyone. Okay, this is what you told me. So almost nobody's still doing the what do you call it, the gateway drug, covered calls, okay, or their cousin naked puts. On Tuesday, I did a follow-on poll, and I asked the folks that were doing covered calls, how are you doing? And almost to the number, almost to the name, we had everybody saying, hey, I've lost money or I'm still flat. Okay, one guy claimed to have been making 3% a month, and when I asked him to share his trading record, he declined. So let's see, 14% doing covered calls, 29% doing long calls and puts, cool, and 71% of you doing spread trades. Okay, verticals, diagonals, condors, oh my, very cool. So we've got a pretty savvy audience today. That's awesome. Let me ask you, how are you doing with that? Okay, how are you doing with that? Just pick one of these 5. Are you happy with your 12-month performance? Okay, would you say, yeah, I'm absolutely kicking butt and taking names? Dude, you should move over and let me teach the class, right? If you're in that category, go ahead and let me know. If you're like, I'm making money, but not enough, go ahead, be honest with yourself and me, and let me know. If you have mixed emotions, for example, you've had some good trades and you've had some bad trades, and maybe you need to rethink your approach, let me know. If you lost money last year, not just lost, but it hurt, okay, ouch, all right, then let me know. And if you're ready to quit, let me know. Now, right now, all the answers are concentrated in just 2 categories, which is interesting. I'm always looking for patterns. Very, very often I see about 20% in the first 2 lines. 20% in the first 2 lines saying either I'm absolutely kicking butt and taking names or making money or not enough, but not enough. Usually it's 20% in the first 2 lines and 80% in the other 3 lines. Today, I'm going to go ahead and share it right now. Let me close and show the results. Today, I had nobody say that they were happy enough that they thought they ought to be teaching the class, but 14% instead of 20 in the first 2 lines, we got 14% in the first 2 lines, and all of it's concentrated in the second. It's making money, but not enough. Okay, so the rest of us are having mixed emotions, okay? The other 85% of us, 85, 86, roundings involved here. That's why it looks like it's 99. 71% say mixed emotions. I see potential, but I need to change my game. Fellas, ladies, you are in exactly the right place. I'm going to show you how I began to turn my trading career around and become a winner. But more importantly, how you can do the same. Okay, 14% say, ouch, I lost money last year, but fortunately no one said I'm ready to quit. So that makes me encouraged. Okay, all right, good. All right, so I'm going to show you my cool triple dip structure in a moment here. I think you're going to really dig it. You're going to like this a lot. Okay, but first, I'm going to start off with a line of thinking that began in 2002. Remember I said I was doing covered calls in the late 90s. It was 1999, before the dot-gone crash of March 2000. That I got involved in trading covered calls. So I actually lost all of my money before that crash. Okay, but I'll show you the line of thinking that began in 2002 after I, like I said, looked at the fight tape. I watched and I said, okay, Frankenberg, here's your mistake. Here's where you let your guard down, right? And we're going to talk about bulletproofing, and that's kind of an interesting idea. The idea that you might be able to trade a stock without risk. Now, I'm not going to claim that you can do that from the get-go, okay? But it's possible that you can start out with stock and a put option that protects your stock, but then get that put option paid for so that, gosh, you've got no downside anymore to your stock, but it still has upside. Okay, does that sound attractive? A lot of folks dig that, okay? All right, so here's a structure that causes us to solve the biggest problem with trading covered calls, okay? And we call it the married put, all right, the married put. And what I'm going to do is I'm going to take you into the power options screen here, and that's going to be, bloop, okay, over here. Let's see. That's one married put. Let's do, let's make a whole brand new one, okay? All right, what I'm going to do is show you the plain vanilla married put. Okay, plain vanilla. And the reason I call it plain vanilla is this is the way that if you take a course that teaches options trading, this is the way they'll show you to do it, okay? They'll say, okay, what you need is you need stock, right? Let's use a familiar stock that everybody knows, at least here in America, everybody knows, okay? And, gosh, most places abroad, I think, too. Okay, Starbucks. We're going to use that. And we're going to go out about 29 days, and what we're going to do is we're going to buy a put option. Okay, and that put option is going to keep us from getting hurt. Okay, all right, so we get a put option at $58.50. Yeah, there we go. Okay, now, so we're keeping our risk down to less than 5%. Okay, remember that's one of the things I promised you in the email. I said, I'm going to show you how to absolutely protect your stock. Now, if you had a stop order in place, all right, back in the 90s, I traded with a live broker, with a real human that I would call and say, I need you to sell, Exxon for 40 3/4. You know, we actually used fractions instead of decimals back then. Okay, and anyway, I called him one day and I said, hey, you know what, Mike? I figured out the way to call the bottom of a stock for the day. I figured out a way to absolutely predict what the bottom will be. And he says, wow, okay, I've heard this sort of thing before, so I don't really believe you, but go ahead and tell me. And I said, all right, it's where I place my stop order. And of course he laughed, okay, and here's the thing, okay, if you buy Starbucks at $60 and you want to not lose too much, and so you say, okay, I'm gonna place my stop order at 58, what may happen is that stock may go down to 58 that day, or within the the next few days, it'll go down to 58 and then it'll bounce and start going back up, only without you. All right, and if you traded stop orders for any period of time, you know exactly what I'm talking about. All right, but something even worse could happen. What if Starbucks opened tomorrow at $40 a share? Would my $58 stop order be activated? No. I would get called out of that stock. I would deliver that stock at $40 because a stop order is nothing more or less than a market order that gets activated as soon as the trading price is below that. Okay, and so if there's a gap, you get hurt. Okay, so anyway, here is a married put play. This married put is going to keep my possible losses down in the single-digit percents. Okay, on the other hand, we have unlimited upside potential, and I've got absolute control for this next 29 days or so until April 29th. Okay, all right, so that's 58.50 put. That means my exit price is 58.50 no matter what. Okay, over the next 30 days or so, a little less than 30 days. Now, that is plain vanilla. Okay, what I just showed you on the power option screen there, that's plain vanilla. Now, what if we were to do this? What if we were to take the married put and add a covered call? Okay, well, I've already filled this one in. What if we were to take that married put bloop, and add a covered call? Well, okay, that does something, and what it does is it makes us have a cap to what we can earn, but at the same time gives us a bottom, to where we can't lose too much. Okay, we can't lose too much of what we've invested. All right, so that's kind of cool. I like that. I appreciate that. But what I'm going to do here, folks, is show you a similar play. Okay, similar play. Okay, here's a very similar structure, the bull call spread. Now, since I think it was 71% of you told me that you're doing simple spreads, you're going to get this. You're going to know this. Okay, so let's go over to the power options screen. We're going to look at the bull call spread. Okay, you ready? Right now, we're on the married put with an added short call. Right? It's also called a collar. And now we're going to click over, and it almost doesn't look like we've changed at all. It looks very, very similar, doesn't it? Okay, here we are buying a long call and selling a call short, okay, and collecting collecting a bit of premium. So now, if we're buying at 250 and selling at 150, that costs us $100. How much could we lose? Well, we could lose that whole $100. How much could we make? Well, if the stock goes up and we're trading right where it is now, if the stock stays flat or continues up, we would end up with a 50% return on our money. That's dope, yo. That's pretty good. Okay. All right. Now, this is important for us to understand. Okay. Now, why would I want? First of all, again, this is not the end. This is the beginning of the line of reasoning that got us to where we are now with radioactive trading. So I'm showing you just a portion, all right? And then we're going to be showing you some really cool stuff here in a moment, all right? But I'm just walking you through the thought process. Why would we use a married put plus a covered call instead of just doing a bull call spread? Okay, why? Why would we do that? Okay, well, there's a very good reason to do that, okay? And here it is. We've got a dollar amount at risk here of $100 and $50 that we could earn. Okay, so now we're going to go over to the radioactive trading, what we call the trade simulator tool here. Okay, and we're going to look at, hey, we could make 50% on our target return. Okay, and of course we could lose, 100%. Okay, if we were to do this for any length of time, okay, unless we have nothing but winners, we're going to end up broke, right? You see that? We're going to end up broke in a great big hurry. Okay, not cool. So let's enter management techniques. I know that all of you guys that have done the courses and so forth, there's some folks out there, including a friend of mine named Jeff Ziegler, that does a credit spread trading course, okay, and debit spreads, and what we're going to do is we're going to look at, okay, what if you could manage it, okay? What if you could manage it to where you wouldn't lose too much, okay? Let's say that we could keep that managed loss down to 40%, okay? So if your stock goes down, instead of losing the whole $100, right? Whoops, here we are. Instead of losing the whole $100 that you could lose, okay, you only lost, say, 40, okay? And so you still have $60 left over. You only lose 40. Would that be okay, okay? All right, so what we're going to do is we're going to put our loss limit in here of 40. So all we can do is lose $40 because, we're smart like that. But on the other hand, we could make $50 if we're right. Hey, all right, good. Oh, but there's a problem. The problem is we're wrong just slightly more often than we're right. Okay, so let's see how this plays out. Okay, I'm going to go ahead and click that. And, oh, wow. Okay, now it took us 36 trades to go bankrupt instead of just 1 or 2. Let's run it again. Okay. Oh, we're bankrupt after, say, 12 trades. Okay, let's run that again. We're bankrupt after 45 trades. Now, here's the thing. Starting out with a couple of wins, all right, and then having a strings of wins and strings of losses, just like in real trading, all right? This is a simulation here. We might mistakenly believe that we've got a winning trading system because, look, we took $10,000 and turned it into $61,000. And I know what some folks are going to say. They'll say, well, that's where I'll quit. Sure, okay, all right. You've taken your money and you've multiplied times 6, and that's when you quit. I don't know. I think most folks would probably stay in there. Whenever this falls below $250, it considers you bankrupt. Let's try it one more time. 90 trades it took us to go bankrupt this time. How about that? Okay, but still, this is a losing system. Now, what I'm going to do is I'm going to insert something. And what I'm going to insert is money management. Instead of taking all of our capital and playing it, what we're going to do is we're going to only play 10% of our capital. Let's see if that makes a difference. Okay. Well, here we lost more often than we won, but still we didn't end up getting hurt too badly. Okay. This time we did get hurt badly. This time, not so great. Still not great. Taking $10,000 and turning it into $7,900 is not my cup of tea, especially after trading it 100 times. Okay? All right, so what can we do about this? Well, let's see. Instead of doing the bull call spread, which looks a whole lot like the collar, why don't we do a collar? And what the collar will do is it'll force us to commit enough of our capital that instead of making 50% on the way up, we only make 2.4%. What? Why would we want to cut down our return to just 2.4%? Well, I'll show you. It also cuts down your loss to 1.7%. Okay, all right. So let's go back here, and we're not going to change anything. We are going to go back to 100% invested because guess what? Now our money management is built in. It's built in. We're forcing ourselves by buying the stock, right, and the put and selling a call. We're forcing ourselves to commit a lot of capital, right, but not put all that capital at risk, okay? All right, and what we're going to do is we're going to change these parameters to what they become. They become, just a 2.4 target, okay, and just 1.7 loss, okay, and now let's run that. Oh, well, look, even with more losses than wins, we took our $10,000 and we turned into $10,016. Not super impressive, but you know what? It's not a losing system anymore. How about if we happen to be right half the time? Now we take our dollars and we turned it into, 10,000 into 13,000. That's a 38% return on the money. Okay. Now, if we still got a problem. Okay. The problem is we're losing a lot. All right. And so if we lose more often than we win, we're not going to do so well. But even if we win slightly less often, okay, I'm trying to find a good example. Here's one. Even if we lose slightly more often than we win, we can still make money. Even, look at this, we're losing more often than we win, right? And then took 10,000 into 13,000. Now, this isn't it, okay? This isn't the whole deal. I'm just showing you the line of reasoning. I'm showing you the evolution, for lack of a better term, okay? All right, so why do a married put plus a cover call instead of just doing a bull call spread? Well, it forces you not to risk too much of your capital. However much capital you've got is however much capital you've got, okay? But by doing this structure that I've just shown you, you are forcing yourself not to risk too much. Now, I've got a different structure I'm going to show you now, okay? But the principle that we've been using is the first of 3 principles. The first principle, and I'm getting ready to show you the other 2, okay? But the first principle that radioactive trading is based on is forcing ideal-sized trades, forcing yourself not to risk too much, okay? Now, here's the results that I got right there, okay? where folks were saying, making money but not enough, mixed emotions, or ouch, I lost money last year. I think that every single person here would have done better. We're going to poll you again in a moment, but I think every single person here would have done better last year if you had simply exercised this one principle really, really well and really, really consistently, forcing yourself not to risk too much. Okay, now, what I mentioned is that, and that simulator tool, I just wanted to let you know where to go for that. Okay, it's on radioactivetrading.com. It's on this tab, the resources tab. You hit the resources tab, right? And then it'll give you a choice here. It'll give you a 2-week subscription to Power Options for free, or the Trade Simulator tool. If you hit the Trade Simulator tool, you can prove this to yourself at home. The Trade Simulator tool lets you adjust all the different types of scenarios, and then it gives you a simulated trading record of 100 trades, and it'll let you know if you've got a winning-ish system or if you don't have a good winning system. Okay? All right, good. So back to work now. So now we're getting somewhere. I just showed you the most important principle of trading if you were able to receive it. When I showed you forcing an ideal size position, you're making yourself not lose too much. That's where we're going to begin. Okay? Just like in my martial arts classes, the very first thing I teach everybody is not a triple dip flippity flip kick. Okay? I teach them how to keep their hands up. Say, look, this is how you weather the blow. This is how you keep yourself safe in case you are struck. All right? And then from there, now we can build something. Okay? All right. Now, we're going to move on to a very different type of married put, and we call this the radioactive profit machine. It's very, very different. Okay? So let me put that up on the screen here. And I'll clear out a few things, okay? Let's clear out that. That's our plain vanilla. You know what? I'll leave that up to. That's our plain vanilla married put. We'll clear out this. Okay. We'll clear out that. And bazinga. Here we are. This is a radioactive married put. Now, looking at this, it doesn't look very different from the plain vanilla married put. Here's the plain vanilla married put, okay? We've got stock, we've got a put option, we're risking $247. That's what all this red water is about if the stock goes down. We've got 4.1% risk, okay? Now let's look at this one. We're risking $267 instead of, what was it, $247. So 20 more dollars, okay, or 20 more cents per 20 more cents per share. Okay, our risk, instead of being instead of 4.1, it's 4.3. Okay, but it doesn't look very different, does it, structurally? But it is very different. Here's why. Take a look. This put is 4 months away. The put with the plain vanilla married put is only 1 month away. It's actually slightly less than 1 month away. Isn't that something? So we're buying an out of the money put option 1 month away, and it costs us 89 cents. And now the difference between what the stock costs and what we could lose if the stock goes down, the difference is $247. So, wow, we could lose $247 if the stock goes down, but if it goes up, we're good. Okay? And let's look at this, okay? This is the radioactive profit machine married put. We are clear all the way till July expiration. So that's, what is it now? It's not even April, but it's going to be. Okay, so April, May, June, and then 3 whole weeks into July. This is about 100 days or more. There's more than 100 days. Okay, so we only take on 20 cents more risk by buying the put. But the put that we buy is the $60 put, and we're buying it far away in time. Isn't that something? There's a big difference. You get what you pay for. I'm paying a 20 more cents into this, and getting that much back out. Okay. Now, if you only look at the cost of the put, you'll say, well, that's more than 20 cents more. But no, this is how it works out. Okay, you're buying the stock. buying the put option far away in time. This is how much you've spent on the stock and the put. This is how much you could lose. Okay. Over here in the plain vanilla married put, what have we done? We've spent less on the put, but let's not forget that it's out of the money, meaning that the put option that you bought so cheaply only provides protection at the $58.50 level, not the $60 level. Okay, it's like a deductible on your insurance. Okay, so you pay for good insurance, but you get what you pay for, and that's awesome. Okay, so why do I pick a put option that's far out in time? Well, here's the thing. I don't have any intention, and get this, guys, this is important for you to get. I don't have any intention of holding this put and stock combination for 4 months. I will only hold it for 1 month. Even though that put option is 4 months away, I'm going to only hold it for 1 month. Okay, now here's why. Okay, you'd think that buying that far away put is expensive, but it's not. Okay, time value falls off slowly, and in fact, this is why we named this radioactive trading. This is the second principle of radioactive trading. We showed you the first principle is force an ideal size trade. This principle is called the red line curve. Red line stands for radioactive exponential decay. Now, here's the deal. If I only want to hold for a month, I could buy a put option that's 4 months away and sell it when it's 3 months away from expiration. And look how much decay I'll suffer from the time value. Not much. On the other hand, with buying a put option that's close in time, look how fast that thing falls off. It falls off really quickly. Okay, and so what we're doing here is we're making the most of our purchase. When we buy insurance, hey, you shop around, don't you? Isn't it better when you buy insurance for your car, for example? Isn't it better to pay by the year than pay by the month? Yeah, this is kind of like that, only it's more pronounced. All right, I'm being able to get a great deal on my insurance, and you know, I'm only going to use it for this 30-day period, right, before resetting or selling. But you know, I'm not going to see this kind of a decay. Kind of cool. Now, in the interim, we're able to take income one of 12 ways, and this is the third principle of radioactive trading. The third principle of radioactive trading is to be able to use whatever kinds of spread trades the market makes available to capture premium and offset the cost of your put. Oh, now we're talking. Okay, now today's income method, the one I'm going to show you today, is called the money net, and you'll see why. It's kind of cool, okay? We're going to go back to our example of the bull call spread, okay? The at-risk amount of the bull call spread is what you pay for it, right? You buy the 58.50s, you sell the 60s against, you have a net debit. Well, whatever you paid, that net debit is what you have at risk. In our case of our bull call spread today, it was $100, right? So if the stock just goes in the toilet tomorrow, the most we can lose is $100. All right, so we're not out too much. That's cool. All right, but what if we got paid to have that structure in place? Wouldn't that be even gooder? All right, sorry, my mom's an English teacher. This is a form of rebellion. I have to do it. Okay, I say ain't and hardly and hardly never, stuff like that. Okay, but what if we could get paid to put this structure in place? That'd be much gooder, much gooder. Well, one way that we've learned how to take a credit is to sell a call, right? If we sell another call, we end up with a new structure, and that structure is commonly known as a ratio call spread. Now, I'm going to go ahead and show you the ratio call spread, okay? If we were to sell, hang on just a second. There we are. All right. I'm going to pull up the custom spread tool here. If we were to sell two calls against every one that we own, we might be able to pay for our spread. There's a problem with that, but it still, you know, seems like a good idea on the surface. Okay, I'll tell you about the problem too here in just a second. Now watch this. This is kind of exciting. Okay, if I was to buy one of these and sell two of those, Okay, what will happen is I'm going to get paid to put that position on. I'm going to get paid to put that position on. I'm getting paid $1. It's not a lot. Oh, that one says total cost. Well, you know what? Slide me a little bit of slack here. Let's say that I could get that for a nickel less. Okay, let's just say that, because that does often happen. Now, if I could get that for a nickel less, now I'm getting paid. Okay, there we are. So I'm getting paid $4 or 4 cents per share. I'm getting paid $4 to put this trade in place. Okay. You know what? I don't know if I like that. I think I would like to do better than that. What do you guys think? Let's do better than that. Let's do a different strike. Okay. I have to change this on the fly because guess what? We've got live options that I'm playing with. Okay, I'm sharing this with you. And by the way, I should make a disclaimer. I should make sure that everybody knows I'm not doing a recommendation here. I'm doing a demonstration. All right. Okay, very good. Okay, so that's much better. So what we're doing is we're selling twice as many calls as we're buying, and that creates a net credit. Okay, in fact, you know what? Let's go back to what that organic price was. It was $2.55. Okay, so we'll submit that. Okay, very good. So what's happening? Well, we're getting paid $50 to get into this, $51 to get into this. All right, $1.53 times 2 is 306. Minus the $2.55 that it costs to buy that long call. And so now we've got a position that we've been paid 51 cents to get into. Now, here's the deal. That's 51 cents if the stock goes down. It's 51 cents if the stock goes up. It's 51 cents if the stock stays flat. I get to keep that 51 cents. But another thing, too, is what if that stock stays flat? Well, at expiration, those $60 calls are going to expire worthless, but the $58.50 call is going to be worth something, isn't it? It's going to be worth $1.50. So, wow, look at that. I'd be able to get paid to close this. That's kind of cool. Okay, so I could get paid to get to open this trade, and I could also get paid to close the trade. But there's a problem. The problem is this. If you sell that second call, you end up with infinite risk. All right, let's look at that again. If the stock decides to keep going up, well, one of those calls is naked. And what that means is I might be called upon, literally called, it's why it's a call option. I might be called upon to deliver shares of stock at 60, even though Starbucks is at 66. Wow, there I'm losing $400. Okay, even though I got paid to get into this position in the first place, now I've got to pay out the nose to unwind it. That's not cool. That's not cool. Okay, so there is a problem with doing a ratio call spread, but I told you that there is a way to do this completely without risk. I said that there is a way to do the ratio call spread completely without risk, and there is. But there's a catch. The catch is you have to be doing the first principle. The first principle of radioactive trading was force ideal size trades. Force yourself not to trade too much capital or put at risk too much capital at a time. And the way that we did that was we bought the stock and the put. Okay, so here's the deal. If you own the stock, that's the catch. Okay, you can make this completely riskless, but the catch is you have to own the stock. So let's look at this radioactive profit machine play, and then we'll look at it with the ratio call spread in place, okay? All right, let's go ahead and take a look. Whoops, hang on. Windows 10, man, I'm still getting used to it. Okay, so we've got this play right here that we just put together using today's prices of the ratio call spread, 58.50 call, and selling two $60 calls against it, getting a small credit, and maybe another credit later, all right? And then we're doing it in the context of not our plain vanilla Mary put. We wouldn't want to do that, okay? Let's axe that. Let's do it in the context of our radioactive profit machine Mary put, okay? So here's our radioactive profit machine where we're buying a put that's far away in time, okay? And now we're going to buy the near in time 58.50 call and sell 260 calls against it, okay? So when I say buy, it picks the ask price. When I say sell, it picks the bid price. So this is as honest as it can be. Okay. Look at what our hybrid position is. Interesting. Now, what happens is as the stock goes up, right, we're having what's called a triple dip. A triple dip. And I'll explain the triple dip here. But one thing is we like stock going up when we own stock. Okay. Another thing is we like stock going up when we have a bull call spread in place. And another thing is we like stock going up when we have a covered call in place. And actually, in truth, we've got all three of those situations going on at once. We've bought stock. We've also bought a put to protect it. We've sold a call, so that's a covered call. And we've done a bull call spread by buying one and selling one against. Okay? But if you've been counting, that's 2 short calls total, right? Bought stock, sold a call. Bought a call and sold a call against. Okay, and so now we've got 1 call and long and 2 calls short. Hopefully I'm not, confusing you. All right, but the point is this: we've done a ratio call spread with 0 risk. Well, take a look. Here's what the risk is of the ratio call spread. Right? It's extremely risky. All right, and here's what the risk is of doing this play with the radioactive profit machine. Now, I have to point some things out. Number one, yeah, there does seem to be some red water left here, but how much is it? 3.6%? Wait a minute. That's less than if we didn't do the income method. Let's unwind the income method. What was it? 3.6%? Let's unwind the income method. Let's see if it's, it's riskier not to have the income method in place. See that? The most that you could lose here is 4.3%. Dollar amount, $267, all right? But if we were to put in the money net, we call this the money net, where you buy 1 call and sell 2 against. It's also called a ratio call spread. If we put the money net in place, right, we're going to lower our risk. Let me look at it with you one more time. Before I press enter, 267 at risk, right? After I press enter or after I press submit, then it's 221 at risk. 221 at risk. Isn't that something? Now, let's do a little bit of math, okay? Let's do a little bit of math. What if that stock goes to $60? We already talked about that. If the stock goes to $60, why then our 58.50 call is going to be worth $1.50. And we've already collected what was it, 50 cents to do this? Here, let me look over here. We collected 51 cents to do this, right? So we take away 51 cents off of the cost basis of that put. What's 262 minus 51? It'd be 211, wouldn't it? Okay. And what if that stock closes at $60 a share? Well, we're going to collect another $1.50. So another $1.51 comes off of here. Okay. All right. And so what will happen is the calls are going to all expire, right, or be managed. We'll show you management here in a minute. But then we'll be left with a stock plus put position in place where now we've only got 66 cents per share at risk and 3 more months left to expiration. Does that make sense? That's what happens if our stock goes up like that, okay? Now, what if the stock went to 61 instead, okay? What if the stock went to 61? Well, our 2 short calls are going to be worth $1 a piece. If we buy to close one of them, that's going to cost $1, right? If we buy to close one of them, that's going to cost $1. That's $1. Negative. How do I do that? Make it a negative. Okay, it's a negative. It would cost us $1 to close this. If the stock goes to 61, okay, it's going to cost us $1 to close one of those short calls. What will be left? Well, a $58.50 versus $60 bull call spread will be left in place. Okay, and so what that means is we'll capture the $1.50, right? Capture the $1.50, and so we'll get paid 50 cents. I don't know why that went to $2.50. We'll get paid 50 cents. Okay, let's do it without the calculator. When the stock is at 61, I've got two short $60 calls, right? Buy one of them for $1, leave whatever's left in place. What's left in place? Well, what will be left in place is one long $58.50 call and one short $60 call, and the stock's at 61. So I'll get paid $150. So I'm spending $100 to get $150. Not bad. I like that, especially since my stock went up. You get to hang on to the stock, right? So hopefully everybody's following this, and if you're not, that's okay. We've got a recording. You can go back through it, all right? But the point is this, okay? If you were to, oh, and this will be fun too, all right? If you were to run this a second time, you would be in what we would call a bulletproof position, okay? Let's say we did this in April, and then April 29th comes and goes, and we end up with our married put again with a tiny amount of risk. What if we were to run this again? What if we were to do something again where we're selling, or we're buying one and selling two against? Buying one, selling two against. We would have an interesting situation where we're pretty much bulletproof, okay? Can't lose anything because if the stock goes down, you know, you've paid less for your stock and your put than the put's strike price guarantees. On the other hand, wherever that stock ends up, it's going to do well for you. And if it stays flat, it does even better. It does the best. Kind of cool? All right, folks, I'm going to touch base with you, okay? What do you think about that? In the first place, what about the first principle of radioactive trading, keeping your risk down to single-digit percents? If you kept your risk down to single-digit percents, would you have done better last year? Would you have done better if you never took a loss of greater than 2 to 5%? Okay, let's answer that honestly. This is income method number, I'm sorry, this isn't income method. This is principle number one. Principle number one is force ideal size trades. Make it so that you can't lose more than, say, 5% of your capital. If you had done this, would you have had a better year? Okay, doing good so far. I'm going to leave that poll here in another 10 seconds. Actually, you know what? We can probably just do 5 seconds. All right, 3, 2, 1, close. I want to point out what no one said. Okay? First, let's do this. What nobody said. Nobody said, keeping my risk under 5% wouldn't have helped me. 17% of the audience says I might still lost, but I would have lost much less. Okay, good. 33% lost overall last year, but would have won if they'd have done that. 67 did okay last year, but would have done better. And 17% came in and also added, would have been one of the very few that were happy, extremely happy with their trading results. Okay, very, very cool. All right. So what do you think about this? Okay, I'm going to show you, what do you think of spread trades that don't risk anything? They take income, but they don't risk anything if they go against you. Okay, they don't risk any capital, and yet, oh, hang on, guys, I'm looking at a question, and yet leave the upside open. I haven't shown you that. I'll go ahead and show you how to leave the upside open. That'd be kind of exciting too, wouldn't it? Okay. What do you think of spread trades? This is one of the other principles, okay, principle of income methods. What do you think of spread trades that take income, risk nothing if they go against you, and they still leave the upside open? What do you Think about that. Okay. All right. So this is what the room thought. I'll leave it up there for another 3 seconds, 2 seconds, 1 second. Okay. So 50% that answered the poll said that beats the shiitake mushrooms out of covered calls. Oh, you bet. Yeah. This can result in a lot better premium than a covered call. And 75% want to know, can I do that in my IRA? It depends on your custodian. But most brokers understand this, okay? Some brokers don't get it, okay? For example, I'll name names. There's Fidelity. They don't get it. They don't get it. They don't realize that you can sell 2 calls against your stock and a long call that you pick up along the way. They don't get that. They say, well, that's margin. No, it's not. There's no margin required because guess what? You have the stock on hand to deliver, and you also have a guarantee of buying the stock at a lower price than you're selling the calls at. So no added risk. There's no added risk. But if your custodian doesn't get it, you can roll over your IRA into another broker that does get it. Okay, so that's a good question. All right, cool. Okay, let me go ahead and look at the questions because I've been yammering on here. Okay, good. Frank had a question about Wade Cook. Yep. And Andrew typed in. Okay, good. Does anybody have any questions so far? I've got a few things to add. Okay, good. Let's see. Alexander says, did you receive my email about coaching sent to Kurt F? You know, I got a couple of letters for coaching, Alexander, and I haven't gone through them all. You should, today, you should receive an application. Okay? Okay. Don says, don't we need to keep the sell price one above the put price, the protective puts price? No. Your protective put price in this case was 60, and if you're selling calls at 60 or higher with income method number 5, you're in the clear. Okay, income method number 5, you can sell the calls at the same strike or higher. You could do it higher too, but if you sell at the same strike, you're good. Always do the catastrophe report, Don. Don owns the blueprint, okay, and that's why he knows what to ask here. Yeah, because we have a rule about which call you can and can't sell. Okay, so Don, check your blueprint. You should notice that you can sell calls at the strike price of the put when you're doing income method number 5. Okay, at or above. Above is good. At is still okay. Okay. All right. Good questions. All right. Now, let's see what happens if you double the amount of stock and puts. Okay, if you had done this, let's say, instead of doing it in the context of owning 100 shares and 1 put option, what if you had done it in the context of 200 shares and 2 put options? Well, you do it more slowly. You capture premium more slowly. If you'll notice, we still have a little bit of risk down here, okay? But you leave your upside completely open if the stock decides to go. Okay, if the stock is trading along sideways, it's better that you do the income method than if you don't. If the stock goes down, it's better that you do the income method than if you don't. If the stock goes up, doesn't matter if you did the income method or not. It's going to be about the same. Okay, so is it good to know how to do these things? Yeah, especially when it adds no risk. Let's go back to the original pricing on this. Okay, I'm going to go back to the original pricing on that put. Okay, original pricing on the put, like what you could get the puts for now and what you could get the stock for now. Okay, and you'll notice that we've got an unlimited upside potential still, but if the stock is sideways, you'll be collecting the most amount of premium you possibly could without necessarily having to sell your stock. Isn't that sexy? I love it. I love it. Okay, that's one of our 12 income methods. We call it a ratio call spread, or actually that's the name of it, is the ratio call spread, but we call it the money net. It's the money net because when you do the trade in the first place, you capture premium. When you close the trade, you may be closing it at a second premium. And if you're not closing it at a second premium, you may still be profiting. Okay? It's super sexy. I love it. What's the benefit of that? Well, there's 4 of them. There's 4 benefits to the ratio call spread. Number 1, you collect a credit for doing it in the first place. Okay? When you look at the risk with it and without the spread, you're collecting a credit, and that credit offsets your risk. Okay? Let's look at that just briefly. This is benefit number 1. Okay? Let's leave the example up there of 200 shares plus 2 puts, okay? I'm going to submit, and we're going to look at the dollar amount at risk. Okay, the dollar amount at risk is 532, okay? 532. And then when we do the ratio call spread, when we do our play, it's going to go down, okay? The risk is going to go down. What is it? It's 532, okay? So we're going to buy one of these and sell 2 against, and let's see what happens. The risk went down. It's not 532, it's 503. And if the stock stays flat, we're going to get a second premium, and that risk will come down even further. And we'll be able to do it more than once. We'll be able to do it again and again if things go well, okay? It depends on if the market cooperates with us or not, okay? All right. The second is, of course, you can collect the second credit. That's why we call it the money net. You get a credit for spreading the net, and then you get a credit for closing the net 5 different ways, okay? Depending on what the market does, there's 5 different occasions or 5 different ways that you can get a second credit. Okay, I don't have time to show all 5, but you'll have to get the book for that. Okay, so number 3, if your stock goes up, you also gain from that, right? Okay, as the stock is going up, the line is steeper when we have the ratio call spread in place. It's steeper as we climb because we're gaining with the stock, and we're also gaining with the ratio call spread as it goes up. Okay, so that's kind of cool. And then 4. The 4th benefit is, hey, if you do this enough times, you're going to pay for your put option, effectively ending up with a bulletproof stock, okay? Finally, let's look at if we, if this bugger here closes at a second credit, we're going to subtract from how much our put option costs us. We're going to subtract, well, let's just say it's 50 cents, okay? Well, then it'll come down. So now we have 3.5% risk. And if we're to do another one of these plays and capture another 50 cents on the entry, and let's say $1 on the exit, okay, we may bring this down to just a teeny amount, right? Bring this down further and further by capturing income. Bring down, when I say bring it down, we're bringing down how much we could lose. And still we have the unlimited upside potential. Kind of sexy, okay? All right. And once we have paid for our put options, we are bulletproof. Now, that sounds like an elusive, magical, unicorn-like stasis, state of being, okay? But in truth, it's commonplace. We do this all the time, all right? If you're a member of Fusion, for example, you get to look over the shoulders of Radioactive traders and see that they're doing it, and you get to see it happen live in real time. You get to see them enter the stock and enter the put and then execute one or more of 12 income methods and then come out on the other side bulletproof. Now, do they sometimes lose? Yeah, but they never lose more than single-digit percents. And that's kind of exciting. Okay, so ladies and gents, that's the show for today. We practice around here 12 different ways to enhance our profit or reduce our risk, or both, by using the income methods. And if you'd like to know more ways to do these kinds of maneuvers in more kinds of markets, eliminating the fear of losing or the fear of losing out on the upside and making the most that you can, you're nodding your head, yes, I can tell, then pick up your home study kit on the way out today. Okay, the home study kit. Now, I'm going to talk about the home study kit here real quick. Now, first of all, the blueprint is part of the home study kit. The blueprint is $339, and it contains all 12 income methods, okay? Actually, this is old. It says income methods 1 through 10. We recently added income method 11 and 12. All right, so income methods number 1 through 12 are included in the blueprint. The home study kit is the blueprint plus 6 audiovisual CDs that explain them in a dynamic, animated, sound plus pictures manner, not just text. And so the home study kit is $5.99. The blueprint is $3.39. If you learn better in a multimedia, a multimedia kind of environment, then the home study kit is your best bet. It's $5.99. If you feel like, well, shoot, I don't need all those bells and whistles, I can just read a book. Well, the book is $3.39. Okay, so whichever of those makes the most sense to you, that's what you should do. And I should mention to you now that we have a 100% guarantee. Okay, so let's say that you were to make an investment. Okay, let's say it was a married put. Then your married put costs a certain amount, but you can't lose too much if your stock goes down. On the other hand, if your stock goes up, well, there's no limit to how high it can go. Well, it's kind of like your opportunity right now. When you spend on a product that's going to teach you about how to invest a certain way, you could lose that investment. If you're paper trading, that's all you could lose. Okay. On the other hand, it just might be the thing that you need to bring you up to winner status. Okay. Now, here's the deal. You're being offered a bulletproof offer. I thought long ago, if I'm going to teach folks about bulletproofing stocks, I'm going to have a bulletproof offer. All right. So this is the representation of a bulletproof stock, where what you've spent for your stock and your put is actually equal to or less than what your strike price of your put is. So you have nothing but upside potential and no risk. Well, that's what our offer is. Okay, our offer is 100% guarantee. We have some bonuses that we'll make available to you. You can keep the bonuses, even if you don't keep the blueprint or the home study kit. But the blueprint and the home study kit are going to be necessary for you to get all these benefits that we're talking about, okay? All right, so real quick, here's a testimonial I like to use. This is a gentleman that was doing growth stocks. Dear Kurt, I've received the blueprint and am a total believer in the methods. Thank you so much for the idea of bulletproofing my stocks. In the last 6 months of trading, even though 6 out of 10 growth stocks cratered, I was able to manage all of them with absolutely no loss. Now, how can he do that? Well, by buying stock and a put together, when his stock started to go against him, his put was gaining in value. So he was able to sell them separately. But he had also done some income methods, and the income methods also offset the stock's loss. Okay, so he was able to get out of 6 bad trades. The 4 good trades, I'm sure, made him money, right? But he was able to get out of 6 bad trades with no loss, and look at this. In some of them, I even made money. Now, that's interesting. You know, I had a client here recently that bought into Calmain Foods, CALM. He bought in at $55.05 a share, and he sold at $53 a share. Therefore, he made $600. What? Yeah. He bought shares of stock at 55 and change. It backtracked to $53, and so he sold those shares for a $600 profit. How is that possible? Well, his put options went up, and his income method helped him profit, and he also got to collect a dividend. Kind of cool. Anyway, this is a different testimony. I'll read it. In some of them, I even made money. I wish I had known about bulletproofing a year ago. I'm still recovering from some huge losses I incurred a year ago. But since having gone through bulletproofing methods, I am very excited to use put options more gladly than ever before, and I'm slowly making my progress. Sudhakar goes on to say, what is most heartwarming for me is that almost all of my portfolio is bulletproof. Thank you again so much for the blueprints, Sudhakar Rajalu, and you can take a look at other posts that Sudhakar has put on the radioactivetrading.com blog, and these are unsolicited. They're just reaching out and saying thanks, so we appreciate him. So again, it's $339 for the blueprint. It's $599 for the home study kit. And I'm going to give a link to everybody that's here live. I'm going to give you a link to 5 bonuses that would come along with. Okay, so it's trading.com /iridium, IRIDIUM. DIUM. And I'm saying that's a clickable link I just sent to everybody in the entire audience on the chat line. And let's see. I want to see if there's any questions. Do we have any questions there, guys and gals? We're about 8 minutes past the hour, and we've had a real, a good run of it. A lot of material in a short period of time. Don't despair if you didn't get it this first time, okay? I recommend that you go pick up the recording and run through and listen and watch and gain from these examples. Okay, Frank has something to say. I would have to say that the concepts you teach saved my IRA in the year 2000. At that time, I purchased Trade Secrets for $3,000, which has similar methods but not as comprehensive. Thanks. Oh, I appreciate that. Okay, so you're saying, Frank, that the radioactive trading principles saved your bacon in 2000. I didn't start selling the blueprint until 2002, and at that point we only had 4 income methods, but we've developed and uncovered 12 income methods. But you say it was a Trade Secrets, huh? And that cost you $3,000. Similar methods, but not as comprehensive. Okay, cool. Frank, I appreciate that feedback. Thanks for letting me know. I don't know if Trade Secrets is still out there, but if they are, if they were selling it for $3,000 back in 2000, I don't know what they're selling it for now. But if you think this is more comprehensive, that's marvelous. It makes it a deal. Perry says, what about core portfolio stocks I want to hold forever? Do I just roll the puts every couple of months? Perry, that's a good question. And I've got a coaching client right now. I've got 2 coaching clients named John. Okay, so this is John J. If you'll write to me, Perry, if you own the blueprint, okay, I'm not just going to give this away, okay, but if you're a blueprint owner, all right, you are, okay, good. Perry, if you'll write to me at kurtf@radioactivetraining.com, I'd be happy to share with you a way that one of my subscribers, or one of my coaching clients actually, is doing income method number 12 and 7 in combination with each other to hold his stocks for an unlimited period of time. Okay, it's kind of cool. Okay, Frank says Trade Secrets was bought by Thinkorswim. Oh, okay, cool. I know one of the founders of Thinkorswim. I don't think he's still on the board, but Charles Cottle, good old Charles, the wrist doctor, really cool fella. Let's see. How do you find stocks to trade? Asks Aldo. Aldo, I use Power Options. Okay, now so let me show you how fast this is. Okay, we go to Power Options, and I'll slide this up. Now, here's the thing. Power Options is a company that's separate from Radioactive Education. All right, they actually are my publishers for the blueprint. If you look over here on the far right, you'll see the blueprint for sale in the Married Put section of Power Options. Okay, so I just hit the Married Put section. Now watch how fast this is. Ready, search. And we're done. These are all radioactive trades that are ripe for the research. I don't say ripe for the plucking. Okay, you probably want to do your own research, but it looks like there's 31 results of stocks that are ideal. It says down here, search settings saved as radioactive sort by earnings per share growth. Okay, so these all fall under the criteria, the search criteria that I give in the blueprint. Okay, so if you have a Power Options subscription, you don't even need to own the blueprint to do this part, but I recommend that you do get it. That's because all the caveats and procedures and setups and so forth for all 12 income methods and the management thereof, that's all in the blueprint. But if you just want to have good picks that are up to the minute, here it is. It's on Power Options. I'll also send a link to you for that, okay? How about this, guys? www.poweropt.com/RAT. RAT for Radioactive Trading. If you click that link, they'll give you 2 free weeks. No credit card required. It's not a deal where you got to give them your credit card info and then they give you a couple of weeks and then you're on the hook. You know, it's not like that. It's just your name and email address, and you try it out for 2 weeks, no strings attached. What's really cool is the guys in the office, they are all familiar with advanced options trading methods. Okay, we've got bull puts and iron condors and butterflies and double diagonals and calendar spreads and all kinds of stuff. You know what the guys in the office do? They trade radioactively. You know why? Because it's their own money. And so they're using, they know that, for example, one of the guys in the office is the fellow I was telling you about that in 2008, he was long stock the entire year and lost 0.6% in the crash. 0.6%, meaning he had 99.4% left over to trade at the bottom, to buy in at the bottom in March 2009. So kind of cool, guys. We got a lot of thank you letters in 2008. A lot of folks telling us, hey, my neighbor lost 40% in his mutual funds. I lost less than 4%. Very cool. Okay, folks, I'm going to go ahead and close it there. I know there's a couple more questions. Let me answer two of them real quick. Okay, number one, Perry says, I could probably look up 12 and 7. Thanks. I'll write if I have any more questions. Perry, go ahead and write me because it's a specific way that we're aligning that. Okay. And then George says, how much is a subscription for Power Options? It's $60 a month. It's $80 a month for real-time quotes, but you don't need real-time quotes for this kind of trading. This kind of trading is very tame. As far as it's exciting when it pays off, all right, but it's very tame as far as day-to-day management. So you don't necessarily have to have up to the second quotes to cobble together a radioactive profit machine. Thanks, Kurt, says John. Always good. Thank you, John. Always good to see you. All right, folks, it's 1:15. I'm going to go ahead and close her up. We'll see you out there, and thanks, and happy trading. Bye for now.